Um, Good morning, a very good morning. I will be talking about the models. This will bring everything I've taught you together. This series is more like teaching you of the essential things you need to do as a trader. I will go in details and explain what each and every indicator I use on my chart is for, and at the end of this video you should be able to select just one model. You don't have to use all of them. All you need is one, just one model. You understand? Now, a lot of you are chasing every shiny object, every new strategy. You want to chase that, you want to be in that, right? So I am here to take away the blow by teaching 7 profitable model that I have back tested myself. And out of the 7, all I use is just one. Now, no knowledge is a waste, but trust me, you don't want to get into the mental barrier of knowing all of them, or trying to practice all of them, or trying to use all of them in a live market. All you need is one, just one. If at the end of this video you can master one, you've succeeded. Now, a disclaimer: this is not a financial advice. This is only for educational purposes. If you are the type that, after 1 or 2 setups it fails and you give up, and then look for the next shiny object on Twitter, this video is not for you. You ain't gonna make it. But if you are ready to put in the work to what I'm gonna show you, then trust me, this video is for you. I'm gonna make it very short and I'm gonna make it very insightful. Trust me. So first of all, I want to go through the price action model. Now, the price action model is literally using the naked chart. You don't need any indicator, nothing. All you need to look at is price, and this has to deal with liquidity and structure. That is how this model works. Now, safe to say that this model, all you need is one PD array, the order block. If you're trading this model, all you need is the order block. Now, how does this model work? Now, it works in form of patterns. You see the market, it goes down and up, and then we take a sweep below, and then we break, and then we have a retest to the breaker, and then we go further. When we have a retest to the breaker, literally the market always comes back to take out every single person that's entered through the breaker, and then we attack again. So literally this model is built on inducements and liquidity. So right now, here is a lecture, the literature of this model. When price takes out a low and we displace higher, which is a break of market structure, and price comes down and we displace higher, the market sees it's like every single person induced here to buy are comfortable when price gets to this level, right? So we wait to see if these guys have been made a scapegoat, right? And then you see they narrowed it down, take them out, use the order block that started the move, and expand. Now by doing this, every seller right here also gets tagged away, and every buyer right here gets tagged away. The ideology is this: when the market takes out this low, literally fear wouldn't let anybody buy this, right? Because the market is moving down. Now every seller that sold out of FOMO gets knocked out here, because their stop loss is literally here or this swing here. Now we convince them we're coming back to the entry, right? And expand higher, probably give them a margin call, and all sellers are knocked out. Now every single buyer here might be happy, feeling seated, and then we come back here, knock them out, induce every seller that was right here also, and then you have that feeling of, I was right, okay, let's hit this one more time, and then the market expands again. Now you literally see that every single person is out of this market, and this is just the pattern. Now this might not be as clean as this on the chart, but then you have to spot just two things. Where did we take out liquidity? When we expanded, did we create an inducement? Those are the two things you have to spot: liquidity and inducement. Now the PDR rate we use, order blocks. A high probability order block is the order block that digs out liquidity, right? So let's look out for some examples on the lower time frame in 5 minutes. Yep. Okay. So I literally love using my 5-minute charts to look for these examples. But time is fractal. This is present in every time frame, right? So here live, I could say that this is a perfect example too. You could see that we took out this low, right? Took out this low, right? We took out this low, we broke higher, and we had this trend line liquidity, which might have induced every retailer using the trend line that this is a buy, right? And now it induced the breakout traders that this is a sell, right? That this is a sell, and probably they're out. So I'm happy this is a live example. And the last down close candle is this, right? Notice how the market respected the consequent encroachment, the mean threshold of the 2 order block. Why did I select the 2? This is more like 1 order block on a higher time frame, maybe a 15 minutes chart. This is just 1 order block, right? So the market hits that, and then we expanded. Now every single person that was buying here, they are definitely in regret seeing this market above here. Oh, the market stop haunted me. But the truth is, the market doesn't care about you, you understand? Every single person that sold this right here, and the market took them out, when they saw this right here, they might have added another position. This is right enough to blow the account off. Every single seller at the stop, this move right here has taken all of them out. That is the aim and objective of this model. It's just that simple. All you have to draw is just 3 lines. First, liquidity grab. Second, the break of structure. Third, where is the inducement? And fourthly, the order block for entry. Isn't that easy to reduce your problems? And always target a 3R or 1:2R. A 3R or 1:2R. That's enough for you. This is a typical 3R, and then we reverse. Right? Okay. I'm so happy this is live, and that's an example. Okay. Let's take one more example on this model. Let me search for one more example on this model right here. As I said, it wouldn't be so clean, but time is fractal. It occurs in every time frame. You understand? So let's look at this area. It looks dirty though, but let me look at this area. Doesn't seem to have anything clean right here, but I think we might find a setup somewhere here. Nothing clean here. Okay. This is NASDAQ. This model works on every pair. Every pair. Trust me, every pair. I use it on Forex, especially GBP USD. So don't think it's just the indices. So this is a little one, but only a sharp eye will see that. We swept this low right here, dig out the liquidity, we break structure right here, we break the structure right here, and look at that inducement right there. Look at that inducement right there, and we took it out, and this was the order block, right? And we might have taken a long position there. This one is obviously for a sharp eye. Not everyone will see this and trust it, but yeah, that's the setup. And you want to trust that low, that order block to hold. You want to trust it, and that's boom. Now there's a certain time of the day these things occur and activate. Those are the time of the day I gave you to turn on your chart. This occurred at 9:30. The one that just occurred now also 9:30. Now 9:30 is most of the time the activation time. What do I mean by the activation time? If you sight the setup before 9:30, set your buy limit or your sell limit and expect it to activate around that time. When you set those limits in your PDRAs or wherever, expect it to activate at those time of the day that I gave you guys. 2 a.m., 3 a.m., 9:30 a.m., 1 o'clock p.m. Those are nice time. The silver bullet time. The silver bullet time also is allowed, and those are the kind of time that can help your trades to be high probability. You understand? So that's that for the first model. The second model I want to talk about is the AMD, the open high low close, the open high low close, right? So the open high low close, I have explained this before, that it's just quite simple. What does it mean? In a bullish day, you want to be buying up below the New York opening price. In a bearish day, you want to be buying above you want to be selling above the New York opening price. So I'm going to activate this right now. So right here, here we are. So let's take for instance that you're bearish this day, right? Now you want to be a seller from above the new midnight opening price. Now the visual explanation of the this is the visual explanation of this module. So sorry, I forgot to put the open. So let me see the market opened here. So the opening price is fixed and the closing price is fixed. The price that varies is the high and the low. Now we might set the high of the day in London or New York. We might set the low of the day in London or New York. Now when price opens, when we consolidate and we open up in the New York opening time on a bearish day, we want to see an aggressive move above the Asian range, into a key level, into a key level So we want to see this into a key level. Now a key level can be highs and lows. That's your PDRA. That can be a key level. A key level can be your order block, your fair value gap, old highs, old lows. Those can be key levels, right? So when market opens, accumulates, you want to see an expansion or a manipulation into a key level, taking out these highs right here, and we want to see the market respect that key level and throw down immediately. You understand? And this is the New York time. We want to get an OTE, New York OTE starts / retracement and then continuation into the key level for the day, and then we expect a reaction of that key level and then we close. Now you can either catch this right here or catch this right here, or you can catch this right here. You don't need to catch the whole range. You don't need that. You can catch just one piece of this and you're done for the day. Don't stress yourself trying to catch this whole range. Now this can be visualized or can be used for any time frame. This can be used for any time frame. This can be used for any candlestick. This can be visualized into any candlestick. What do I mean? Open, high, low, close. This can be used for monthly weekly, daily, and 4-hour candles. You can also use it for the 1-hour candle, but I like to stop it at the 4-hour because those are important time frame. Now let's take a visual, let's take a real example right here. Now the model is accumulation, manipulation, and distribution. Now I want you to take a look at this bullish wick. Let me back forward this. So this was the opening of this week's candle, right? And this was the close, right? Notice how we opened, we went below it, then we went above, tagged this target, which was the target, and then we closed below. Open, low, high, close. So let me show you guys what it looks like in real time. So this was the week. It started here, right here. So now I was anticipating bullish, right? And this was my target, right? So sorry. So right here, right? So let's go to the 1 hour. So the market opens, we are bullish for the week. Now in a bullish week, we want to be buying below the weekly opening. In a bearish week, we want to be selling above the weekly opening. So now the markets went below this guy, below the weekly opening, right? And you could see we digged into this fair value gap, expanded a little bit, consolidation, and yeah, and boom. I think this was CPI, I think so. And let's see what happens when we take out this high. Now we took out the high, and then you see how we came back into the range to close the rest of the week, right? So this is how it works. This is how the AMD works. Now you can narrow this down into even a 4-hour candle, right? When you're expecting a 4-hour candle to be bullish, you want to see it when it opens up to go below its opening, and that's it. So let me say, for instance, this candle right here, you see we opened up, we went below it, and then we expanded and closed a little. This bearish, we went above it and closed below. So this can be narrowed even to the 4-hour time frame. Now the question is, how do we use this? So right now, this is how we use this. First thing you want to identify is an expansion, because a lot of you might have tough time identifying the accumulation. So you want to see an aggressive move, because whenever you see an aggressive move, definitely you're going to see the accumulation. Understand? So now I can take a small piece. This can exist in any time frame, right? So let me take this small piece. This was an accumulation. We manipulated, we took out this low, and we distributed to the high. Now what are the targets? When we take out the low, when we take out this low, what will be the target? The first target should be the high of that accumulation box, and the second target can be a higher time frame PD array. accumulation, manipulation, distribution. How would you have entered? Well, when you see this accumulation and you notice that this is a sell side liquidity, that the market should quietly reverse, you could as well have entered right immediately to cut that liquidity. This can be used as a turtle soup, and you can keep your stop loss right here to cover all this fair value gap, or you could reduce it to the consequent encroachment of this fair value gap because you want to see an immediate reaction, right? So you want to see that immediate reaction, and from there you can target a 1:2, which is above that consolidation. Let's look out for another example. Now this pattern or this model has to do with the right time of the day. The timing I gave you guys are very vital. You want to see these things at those timing. Now look at this little accumulation. This was inside an Asian section. Accumulation, manipulation into here, this order block right here, and we distributed below it. Now the aim is you always, when you see the accumulation and we expanding, you want to identify a key level which you will enter off from. If it's a higher time frame key level, you might just wait for a lower time frame confirmation and you enter, right? So let's look at another example. This is always there on your chart. This particular model is always there on your chart, right? So the whole of New York, the whole of Asian, we consolidated right here. There's consolidation, this whole consolidation right here, right? Consolidated, and then we opened and we went lower, right? Let me identify if there was a key level right here. Now we took out this swing low right here. So let me check the firewall and know if we had a key level. Now I think this area was it, right? Okay. Now you could use the rejection block as your key level. This rejection block can be your key level, right? This rejection block can be your key level, and you want to see a reaction immediately. Now, what are the kind of reaction you want to see? Basically, from my experience and backtesting, you want to see it immediately create an order block. How do we create that? An expansion of the candle that digs into that liquidity, which is the bearish candle because we are bullish, right? Now we digged into there, and yeah, we swept that low. The moment we swept this low, you could as well have entered with your stop loss where right below this candle. You don't want to see it, you don't want to see it violate this low, right? You could have as well entered and you use the next swing low. So you could use the next swing low, or you could use a lower time frame, and that's the 1:2. Now if you can't use that, you can narrow down to a 1 minute time frame, but I don't recommend this because not a lot of you are that experienced, but then practice makes perfect, right? So let's check out the 1 minute charts if we can find this. So yeah, looking at the 1 minute chart, this is it. So this was the whole 10 right here, right? So now, one of the disadvantages of using this is your stop is gonna be tight and they might hit you out before they remove, which is why you should use a swing on the higher time frame, which is the 5 minutes. But then inside this whole accumulation, you could see that we swept out liquidity. Okay, I can delete this box right now, right? We swept liquidity, right? We swept this liquidity right here. Swap this liquidity right here, and we close above. Now this is a fair value gap right here. You could have entered with this fair value gap and there's no problem, and that will give you, that's how I get my multiple RR move, and that's a nice entry right there. So you can actually use the 1 minute, or you can use the next swing on the higher time frame. So that's literally the model. So what are you looking for? You're looking for an expansion. When you see an expansion, you're looking for the accumulation, and then you're looking to attack above that accumulation, right? Why? Because when the market was accumulating, they were engineering both buy side liquidity and sell side liquidity, and when we expanded lower, we took out the sell side and jammed every order that was on the sell side, and now we need to go jam every order on the buy side, and that's how we got it tagged right here. Now this model can also be used for your market maker sell model and buy model, but you don't want to overcomplicate things, you understand? So the next is the silver bullet. The silver bullet has to do with time. I recommend you go watch ICT videos concerning the silver bullet. So we have the 3 a.m. to 4 a.m. we have the 10 a.m. to 11 a.m. and I think we have the 2 p.m. to 3 p.m. silver bullet. So this time of the days, you wanna look for a fair value gap to enter off to attack a draw on liquidity, which you've marked out on your chart. So now let's look at some examples right now. So all I'm gonna do is mark out those time of the day, and let's see what happens at those time of the day. Okay, so this strategy, you don't need any bias. Sometimes you don't need a daily bias, you don't need the midnight opening, you don't need, but though you can use them as a confluence, but this strategy is just mainly about time and price. So here is your 3 to 4 p.m. window, and here is your 10. Here's your 10 to 11 window. Now I like making my executions on the 5 minutes time frame. Now where is your, okay, there was Thanksgiving, sorry, so they didn't stay open today. But then let's look at the 3 a.m. Now looking at the 3 a.m, what could you see in this window, right? We accumulated, we manipulated, we are attacking this high, right? At 3 a.m. to 4 a.m, what did the market present us with? This was a fair value gap right here, and we used it to attack that high. So this would have been your entry right here, and you want to use this low, or you could use this low and trust it. But then I will always say, give your stop loss a breathing space, and that's it for a 3R. That's your silver bullet. That's it. Then you can actually add other confluence, like maybe we are below the midnight opening and the rest. 11 p.m, sorry, the 10 a.m. to 11 p.m, we are looking for a sell side, and market presented us with a fair value gap, and let me say we entered off this fair value gap right here. Now stop loss just right there, the high of that fair value gap, and I think this would have rewarded us with a 2R. This is a 1:2. Now if the setup is up to 1:2R, it's worth taking, you understand? And that's just your silver bullet, you understand? So now, how many of you can do this consistently without overthinking? Like, you show up today, it doesn't work, you still show up tomorrow and you still do the same thing. A fair value gap, you use that, target a 2R, you're done. 10 a.m. to 11 a.m. the something, you're done. You can minimize your trading by making this two losses in a row, you're done. One win, you're done, you understand? So going to the next day, to the previous day, this was I don't seem to, okay, it was Thanksgiving, so they closed earlier. So this was Thursday. Yep. So let's check out the 14 o'clock and 3 p.m. 14 o'clock and 3 p.m. silver bullet. So this is our 14 o'clock and 3 p.m. silver bullet on the Wednesday, and we could notice that this market, we jumped into this order block. Yeah, you could use that order block and make an entry. You could see the speed right away. Now the aim is that those time of the day you get speed. So now you could have used that order block, but then if you're someone that uses a fair value gap entry, there's no problem. You missed it, it's gone. You come back for the next day. It's just that simple. The 10 p.m. This is the 10 p.m. and this is the 11 p.m. So this is the 10 p.m. and this is the 11 p.m. You could see we use this tiny fair value gap right here, and then we expanded. Now it doesn't mean the whole move has to happen during this time window, but you want to use a specific fair value gap that forms at that time window. And you could see, yeah, we expanded a little bit. Let me see, we took this trade and probably this low would have been our stop, and we targeted 2R as usual, and that would have been a 2R, right? So we wouldn't have any problem missing this guy right here. So now let's check the 3 a.m. the 3 a.m. and the 4 p.m. So in the 3 a.m. by 3 a.m. we just expanded, created a fair value gap right here. Now the market didn't respect it that much, and then the market used instead this order block. Now you notice this sweep of liquidity. Now this is where your buyers plays a huge part. So now the market activated this guy instead. This is still allowed, you understand? And you could use this fair value gap or order block entry, and we expanded higher. And yeah, that's how you use the silver bullet. Now there's another way I also use the silver bullet, but I'm going to talk about that later on. I wouldn't include that as a model, and or I'll probably look for a YouTube video that might probably explain it that way. But then you can, if you understand the AMD and understand that it's all fractal, then you can use your silver bullet with respect to that. So that's it. That's the silver bullet model. Then let's talk about the turtle soup, right? Now A lot of you might be so enticed about this strategy because it's always on the media, turtle soup, catching the sniper and the rest. But it's just very simple, right? Right. So now, if you want to be a turtle soup trader, one thing you have to know is that turtle soup works with respect to time. The time of the day that I've given you guys is the time you need. But then, how do you? Most of you are confused of which high do you pick, which low do you pick. Now, you have to pick a specific high formed at a specific time of the day and at a specific time of the week. The high of the week comes in mostly on Tuesday and Wednesdays. Likewise, the low of the week. Now, when we are in an uptrend, every retracement that digs out liquidity is a turtle soup with respect to the higher time frame objective. So not until the higher time frame objective has been achieved, the trend or the draw on liquidity doesn't change. Now, I think let me look for examples so I can show you guys. Right? Turtle soup. Okay, this was a turtle soup, right? So this low came in at Asia. Now, when you're using turtle soup, the Asian range is very important. The IPDA is very important, and the Monday range is very important. Ranges are very important. Range high, range low. That is all about turtle soup. And I already taught you guys how candles can be ranges, right? So now this is the high of this range, right? Now the market digs into this guy, and the market digs into this low. What's that low? The Asian low. At what time of the day? 9, 8 a.m. What did we dig into? A fair value gap. Now, turtle soup is all about seeing a liquidity close to a PDRA. Expect price to dig it out and dig into the PDRA and expand. That is all about turtle soup. Now we dig it out into the PDRA. How would you have entered? You would have entered the moment that low was taken into the PDRA. You're entering manually with your stop loss as that PDRA that you're entering. That is how you risk it on turtle soup. The PDRA you're using to enter, you use the stop loss, or you can use a swing on the lower time frame. That's by looking backward on your 5 minutes or on your 15 minutes. Then you can use a swing low on this or a swing high as a stop loss if you feel like this is too large for you. So that's it for turtle soup, and yeah, you could enter there, your stop loss right there, and that's the expansion. Making this video is getting too long. So this was a range high and a range low, right? We took out a range high, we attacked the low. Now how would you have entered? Let me narrow down to the 5 minutes chart. Let's see how I would have entered this rule. Now I'm trying to show you how you could enter without a higher time frame PDRA, because I know that if there was a higher time frame PDRA to this, it might be on the left side. So now the idea is always look left before you make a decision. Always look left. What you're looking for might be on your left side of the chart. Always look left. So where is the so this is it, right? Okay, no, this is it. So when we took out the high, we could literally wait for a lower time frame confirmation. Now how do we wait for this lower time frame confirmation? We want to see price dig out, and then you can enter manually with your 2022 module or just a manual entry. Now this wasn't really a strong displacement below this, right? Which is why we took out this high. Now it's not bad to enter here and get stopped out here, but the moment we took out this high and then we displace this, you could just enter right here immediately. Now you shouldn't, while using the strategy, you shouldn't be so concerned about catching the top and bottom. If you stay concerned about them, you're gonna stunt your growth. You wanna stay concerned about your execution. And yes, that was an entry right there, and you can just swing it, targeting those range low, and your stop loss is right above that high. You want to trust that high to hold. The high that digs out liquidity, you want to trust it to hold, or the low that digs out liquidity, and you can target the range low. And yes, that was a 1 minute to 3 hour. So that's how you top soup. I hope I'm clear. Yes, so I'm clear. And let's talk about one last model. Now, if there's any model you feel like after watching this video you want to practice any of the model, but still you feel like let me say you're not confident about them, you can text me, or you can ask me any question in the group chat. You all are entitled to that, you understand? Now, the second model, this is the second model, this is the fourth model, I think so. So another model is this, the higher time frame PDRA and a lower time frame execution. This model has to do with just identifying your higher time frame PDRA, and when price gets to that area, you just have to wait and see what price does inside there. So let's look at some certain swing points on price. Let's look at some certain swing points in price. So now I want to take a look at this area where we tapped into this fair value gap right here, and I will also take a look at this one right here when we tapped into this big fair value gap, right? When we stretch this low, although it looks noisy, this is like accumulation there. So firstly, let's look at this area right here. Let's look at this area right here. Okay, delete that. That's a fair value gap. And yep. Let's look at this area. Let's go to 5 minutes. Now this model can work on any time frame. What do I mean? Your higher time frame PDRA doesn't have to be 4 hours, it doesn't have to be 5 hours, it doesn't have to be daily, it doesn't have to be weekly. It can be a 15 minutes and your execution on the 1 minute chart. It can be a 5 minutes and your execution on the 30-second chart. So now this model is very simple. When a price gets to a PDRA, you want to see a strip on liquidity, an expansion, some kind of 2022 model, and you want to use that as your entry, right? So you're waiting for price to get into a PDRA, a higher time frame PDRA, depending on the time frame you're using as your higher time frame PDRA, and then you're waiting on the lower time frame for your execution after probably a 2022 model presents itself. So this one not really clean, but let me use this. So when price tagged this guy right here, you might have seen this displacement and you might have entered here immediately. Price came back right here, right? Let me say you entered there. Let me just say you entered there, right? And your stop loss is that low right there. Sorry, I'm making this shape. And then you target it to R. Probably the market would have taken you out because of this whole delta 10. I think the news cost that. Then after this happened, this can be our sweep, right? Now this is a very dirty stuff. It's oh shit. So this is a whole because of this spike, this is a whole dirty scenario, but I will still explain it, right? So now you want to enter off whatever the market. So the market now swept this low, right? Now this goes back to your 2020 model. What is your rule set? Your rule set says you want to see a sweep of short-term or of short-term high or low. You want to see a break of market structure with an expansion, right? So now this is our sweep, right? And then we came back to this, right? I think this should be the consequent encroachment of it. Let's check the consequent encroachment. So this is the consequent encroachment of this wick, and we hit it, and you can see an expansion, right? And the market provided a fair value gap. You could as well have entered right there. Could as well have entered right there, targeting a 2R. Might have given you some headache before it hits the target. Now you might as well also target another higher time frame PDRA. So when you're using this model, you want to be targeting low hanging fruits. You don't want to, you don't want to get caught up. So your work as a trader while using this model is you want to wait for price to get into a PDRA, a fair value gap, order block or breaker, volume imbalance, and then you want to go to your lower time frame, be 5 minutes or 15 minutes. You're waiting for a sweep above a short-term high, and you're waiting for a break of market structure, and you're waiting to use a fair value gap or an order block to enter. Isn't that easy to reduce your problems? I guess it is. But then you want more. That's just the problem. You want more. You feel like you want to know everything in the ICT library before you could make money. No you don't. No you don't. So let's look into this guy right here. So let's say I'm using this order block as my PDRA. Let's look at what happened here when you hit the consequent encroachment of that order block, right? So when we hit the order block, we could notice we swept this high right here, came here, created some kind of equals, and then market left us with a fair value gap right here. We activated that, and then we swept lower. Now if you didn't trust this fair value gap, the market provided another fair value gap right here, and you could have entered right here. Sorry, my bad. Could have entered right here with your stop loss right above there, and you could have targeted a 2R, and I think the market would have given you that possibly. So close, but then that was a good setup, right? So that's that for this method. So this method, you're literally waiting for a move inside your PDRA. We hit this. You want to see a rejection. You want to see a rejection to an opposing direction inside your PDRA, and you want to enter off a fair value gap or off an order block. It's that easy. It's that easy. Now, all the rules I gave you, you could make it very easy for yourself by just coming to your Tradingview. Look for this indicator called traders checklist. You could see where I wrote down my trading checklist, right? I want to have my daily bias. I want to see a liquidity sweep and displacement. This is inside a key level and at a specific time, and I want to see some kind of accumulation, and then I'm using my standard deviation for my TP. After I get a change in state of delivery, I'm gonna talk about the change in state of delivery, but it's just the same thing I taught you guys, but it's used with another block. And I set my stop loss on my TP, and this is my risk, and this is my psychology. I don't chase trade, I don't overtrade. One trade at a time, trust every one of it when it presents. So now you could use this to always remind yourself of the rules. Trading checklist by Sonalab, that's the name. Now you could use this ICTK zone to set those time of the day, and this is the settings for my own. Those time of the day: 3 a.m. to 5 a.m., 8 to 11 a.m., and this to this for Asian range, and this to this for the London close, right? So I can literally change this to only the silver bullet if I want to, but this is what I use. This is my own setting. So within this time windows, I search for my setup, right? So then I don't use this Asian range. I'm hiding it. So you can come here and activate the ones you want. I hide the Asian box. It's just the London low, the New York high and low, and the London high and low that I activated. And you can use, oh my bad, you can use this guy to identify the ICTK zone and pivots, to identify your highs and lows, the London high, the New York high, the Asian high, and the London the Asian high, the London high, and the New York highs. So this is my settings to 2 a.m. to 5, 8:30 to 10:30 for New York AM session. I didn't activate the New York lunch and PM. I only do that when I'm trading the PM session, just for clarity. So you could use those to help yourself while you're learning. But most importantly is this trading checklist. Let it have the set of rules you want to see on the chart before you enter a trade. It's going to help you a lot. So I hope you all found this insightful, and I'm still going to touch on the model I use personally. I'm gonna make that a separate video, but every model in this video is enough for you, and all you have to choose is just one. All you have to choose is just one. Then make the set of rules that you're gonna obey to follow this model. What do I mean by set of rules? Number of losses that you can take in a day have to be at least maximum of 3. That's maximum of 2 or 3 losses. You want to be targeting a 2R or a 3R on every trade. Every trade, a 2R or 3R, you pay the trader. And if you do that and impact it into your trading, it's gonna be very clear. Now, before you watch this video, make sure you watch my previous videos for clarity and for more understanding. So I hope you all found this insightful. Till we meet next time, probably the next class will be anytime soon. You all should be safe. Good luck and good trading.